In this episode, we are going to talk about the manner in which, in the course of the 19th century, a modern banking system had emerged. It's a kind of a follow-up of the earlier discussion that we had about the transformation of Indian commercial life in the course of the 18th century. As you come to the early part of the 19th century, you see how the commercial arteries in India had begun to be completely controlled by the East India Company and the private British merchants. Similar things also happened in the indigenous money market, and the origin of modern banking can be traced from the rise of agency house banking in the early part of the 19th century. But these agency house banks actually collapsed because of the kind of connection or the tie-up that they had with their commerce. The usual practice for these agency houses was to mobilize deposits and then use these deposits for purposes of commercial investment. And to solve the problem of bank failures, for the government only in the 20th century tried to impose certain regulations. For example, in 1913, the first legislation was passed, followed up by a few other legislations during the 1930s, in which the bank as an institution came to be legally defined. They were asked to keep certain reserves, they were asked to conform to government policy regarding money supply, exchange rates, currency standards. So until these regulations were actually enforced in the early part of the 20th century, the distinction between banks, which you see in a modern banking institution, and the traditional credit institutions actually didn't exist.
Sir, what was the nature of this traditional banking?
The nature of this traditional banking was quite similar to the kind of banking practice that you see in the agency houses. These traditional bankers, whom you find in Surat or in Murshidabad you have the family of Jagat Sheths. In Surat you have the family of Virji Vora and a few other families. Their primary concern initially was in trade. But in order to be able to finance their trade, external trade, in order to be able to mobilize enough resources for their shipping, they attracted deposits, or amanat as it was called, and used it for purposes of commercial investment. So the domain of the trader and the domain of the banker for some time was not clearly exclusive. There was a very close intermeshing between these two kinds of functions. But it is also true that from early part of the 18th century onwards, when India's external trade began to expand, when European traders were coming in large number, where European trade was also expanding as a consequence of the growing demand for Indian commodities, there was a clear tendency among some of these families to specialize more in banking rather than trading. But it was not a universal kind of a phenomenon. There would be a man like Virji Vora in Surat who would be combining trade with banking, but the family of Jagat Sheth in Murshidabad, for example, concentrated more on banking. Partly because of the reason that the family of Jagat Sheth became the banker of the Nawabs of Murshidabad. In the revenue system, they had a very critical role to play. And in addition to this function as the banker of the Nawab, Jagat Sheth presided over a local banking hierarchy in which money changing was very important. Because Jagat Sheth was the minter of the Nawab, and as the holder of the minting right, Jagat Sheth was the source of the circulation of local currency. And this is connected with money changing. But Jagat Sheth was, of course, not the only person who was responsible for money changing.
So why was this money changing necessary, and why did this money changing become so profitable?
The first thing is that you have different kinds of currencies circulating all over the country. I mean, there was no uniform currency. And before paper currency was introduced, all these local currencies had diverse weights, diverse metallic content. So money changing actually was important, because if you bring a set of inferior currency to Murshidabad and wish to trade at Murshidabad, you would actually exchange this inferior currency for the currency that was circulating in Murshidabad. So given the fact that there were different kinds of local currencies within the Indian subcontinent, money changing was important. Moreover, if you are a minter, as Jagat Seth was, and you have the control over the supply of currency into the market, the European traders who didn't have much access to local resources, who found it difficult to mobilize local resources for purposes of trade, would actually bring bullions and take them to the minter in order for the minter to convert these bullions into local currency. So as a part of this money changing business, issuance of currency for the Europeans was also a very important aspect. But in the money changing business, you will come across a large number of people, shroffs as they were known, who were somewhat inferior in status to the Nawab's banker of Murshidabad. But Jagat Seths also had their equivalents in other important trading towns as well. But below that hierarchy, you have a large number of banking houses, smaller in scale, but they were important as money changers nonetheless. And below that hierarchy, you will come across a large number of local money lenders who are advancing money to the producers, to the artisans as dadon, and these artisans were producing for the big merchants. So it is very similar to the role that was played by merchant manufacturers in pre-industrial Europe as well. So the banking business, or the traditional banking business that you see, was structured like this. But within it emerged certain very important institutions which gave this traditional banking business a fairly solid foundation. One of these institutions, as you all know, was Bima. A powerful banker, a wealthy banker in a major trading town would ensure the commodities which are being taken to a distant place either through the waterways or through the overland route. And the second was hundi. Hundi is basically a bill of exchange, a kind of a promissory note. Supposing you are actually drawing out a hundi from Murshidabad, which has the signature or the seal of Jagat Seth, it could be encashed in any of the major trading towns on the overland route or in a distant port as well. So that hundi, which Jagat Seth issues from Murshidabad, has the character of a modern demand draft. And this was possible only for bankers like Jagat Seth to issue because of the kind of credibility that this man had in the trading circles. So if you look at the traditional banking system, you see a connection existing between commerce, between trading and banking. But gradually, there was a clear tendency towards specialization, which would place Jagat Seth at the apex of a banking structure capable of issuing bills of exchange which were encashable in distant places. To some extent, the agency house banking, which had begun to emerge from early part of the 19th century and has often been looked upon as the beginning of modern banking in India, followed the same procedure, because they were actually mobilizing resources and using those resources for purposes of commercial investment, just in the same way that these bankers were doing earlier. And what is even more important, that in their attempt to mobilize deposits or amanats for purposes of commercial investment, they had the support of the functionaries of the Mughal court as well. Many of these functionaries made available a huge amount of revenue fund from the treasury for the banking houses. When you look at the kind of amanat over which these traditional bankers had their control, it is not as if that they were simply private resources which were mobilized from relatively wealthy individuals. The state functionaries also had a role to play. in this kind of a system, you can see the outlines of a kind of a modern state banking where state becomes involved in investment banking. So this was the basic framework of the traditional banking, from which the agency house banking did not actually radically depart until the character of what is a bank, how it is different from institutions involved in credit business, came to be defined by the laws later in the 20th century. And that is where limited liability was important, because there were a number of bank failures, for which reason until in 1860 the limited liability clause was introduced. The joint stock banking actually didn't develop in India. It is only after the limited liability clause was introduced by legislation, it became easier for the joint stock banks to grow. But before this joint stock banking had begun to evolve, using the protective cover of limited liability, there was a prehistory of British commercial banking here, where the agency houses involved in the export-import trade found it profitable for them to mobilize deposits in order to fund the growing scale of their commerce. Even though one doesn't find much of a distinction between what we have just described as traditional banking and agency houses, the agency house banking actually began to prosper in a situation where Indian capital became increasingly subordinated to British capital. So it was important to establish a certain control over the credit market as well. They will create a kind of a structure, a framework of banking in which deposits would go invariably to these British banking institutions. Moreover, one important function of indigenous banking, as we said already, was money changing. But in 1835, when a uniform currency was introduced over the entire British Dominion in India, the shroffs lost a very important source of their income. So it was not unusual for many of these traditional banking houses to complain against this kind of a measure, which was a source of enormous profit for the middle tier banking houses, the indigenous banking houses managed by the shroffs. The attempt to establish control over the credit market, over the monetary system, and to create a bank through which this kind of control could be established had been made by Hastings.
Sir, what kind of institutions did Warren Hastings try to create in order to regulate this money market?
To some extent, some of the measures that Hastings took anticipated modern state banking at one level. It was also tied with the British attempt to create a uniform currency, because this anarchy of multiplicity of currencies had become a source of much loss for British traders, or because they had to provide a huge amount of commission to the money changers. So what Warren Hastings did in 1773 was to establish a kind of general bank for Bengal and Bihar, which was basically the British Dominion at that time, and introduce in this region a uniform currency, so which is the Murshidabad Sikka. The kind of rupee that was in circulation in Murshidabad became the currency for this entire region. Secondly, the bank became responsible for the transactions between the artisans and the company. So you can see how the banking function as a creditor. In return for credit, this bank was able to collect materials, artisanal production. So in these ways, Warren Hastings anticipated some of the later measures taken by the colonial state to create a kind of state bank, a bank which will perform two functions: to conduct the government's business, to control issuance of banknotes, to manage the government's financial operations, but at the same time it will continue with the commercial banking as usual. So that kind of a measure would be taken later. Early in the 19th century, with the establishment of the Presidency Bank of Bengal. This is known as the Bank of Bengal. A similar measure was taken for Bombay and Madras later in the 1840s. The Bank of Bombay was set up in 1840. The Bank of Madras was set up in 1843.
So, what kinds of role this Presidency Bank came to fulfill as a government bank?
The Presidency banks had their usual commercial functions. But at the same time, the Presidency banks actually issued banknotes. Before paper currency was introduced in 1860, the Presidency banks managed the government's commercial transactions. Of course, the Presidency banks were not able to control the exchange rate, but much of the government's financial transactions were managed by the Presidency banks. The Bank of Bengal in Eastern India and their counterparts in Bombay and Madras. It is not as if that by discharging the government's banking business, the Presidency banks were actually not participating in commercial functioning. They were also doing the same, but primarily it was government banking. These banks were established on the strength of a charter issued by the company. The appointments in these banks came to be regulated by the government. The government actually allowed its own fund to be deposited with the bank, and the balance, the government balance that the Presidency banks held, came to be used by them for purposes of other kinds of commercial investment. So, Presidency banks, by being a government bank, had certain privileges. Later on, when the government felt that a certain amount of regulation over the credit market, a certain amount of regulation over foreign exchange and all that was necessary, these Presidency banks came to be amalgamated in 1921 and Imperial Bank of India was established. This is the precursor to the State Bank. But below the Presidency banks, the Presidency banks came to preside over a modern banking structure in which the exchange banks, controlled almost exclusively by the Europeans, had come to function. Because most of these Presidency banks didn't have any foreign exchange right or right to be involved in foreign exchange functions. Those functions, which were critically important for the banks to perform in order to become useful in foreign trade, were completely monopolized by the exchange banks. Many of these exchange banks were actually located in England. They were created in England, but they had their branches in India. And these exchange banks, almost exclusively under European control and ownership, came to control the money market in India. Most of the deposits they monopolized, partly because of the very simple reason that the trading houses were all Europeans. The foreign trade had come to be monopolized by the Europeans. Indians had been gradually thrown out of circulation, and this was one reason why you don't find very many Indian banks functioning as joint stock banks involved in foreign exchange operations in the later half of the 19th century. Allahabad Bank and Punjab National Bank were the more prominent among the only 9 banks which you see functioning at the turn of the 19th century. Of course, from 1920s onwards, the situation began to change with the rise of Indian-owned banking involved in foreign trade or foreign exchange operations. Until then, these European exchange banks completely monopolized this business. Now, the question of central bank therefore arises at this last stage of this discussion.
So, what were the stages through which the idea of central bank evolved and ultimately created?
You see a banking structure by the 19th century. You see a few legislations being introduced through which joint stock banking began to emerge. But there was still an element of anarchy because there was no regulatory authority. some people felt that Imperial Bank was the best institution to manage this business. The Imperial Bank, as a government bank, would be able to regulate money circulation, regulate exchange rate. That was the government business part of the Imperial Bank's functioning. The other part was the commercial functioning of the Imperial Bank. But later, it was realized that the two functions are very difficult to blend, because you need to have a bank which will be a lender of the bank. Because if the banks were actually running into rough weather, the lender bank, the central bank, would be able to lend them money. So a regulatory bank had to be created in 1934 when the Reserve Bank of India was set up. In the meanwhile, there were several attempts from the early part of the 19th century down to 1910, when John Maynard Keynes, in fact, came up before the Royal Commission for Indian Finance and Currency with the proposal to convert the Imperial Bank of India into the state bank. But these proposals were not ultimately put into effect. In 1934, the Reserve Bank of India was established with the regulatory power, with the regulatory authority over the banking system. And in 1935, a new set of rules were framed by which the Reserve Bank eventually became the custodian, became the government bank, became the central bank with control over exchange, foreign exchange, and monetary reserves. We can conclude this discussion by way of answering your question. If you look at the prehistory of the initiatives towards the creation of a central bank, you see an early proposal early in the 19th century from a man called Robert Ricard. His proposal was to create a central bank in order to perform as the government bank. But at that time, because of the predominance of local interests, Madras traders, Bombay traders, Bengal traders, they had their own spheres of interest, this proposal was not acceptable. An ambitious scheme in 1836 once again tried to combine the principle of government control with normal private banking. Once again, that proposal was not acceptable to the Bank of Bengal, which resisted the idea of centralization. Similar resistance you will see from the other presidency banks later, when such proposals were floated periodically by the officials. So you come to 1910, and I was referring to John Maynard Keynes. Keynes came up with the idea that Imperial Bank can be converted into a central bank. But eventually that proposal was not put through, and you have an alternative option that was more acceptable to the government. But the rise of modern banking, as you see today, happened in the larger context of subordination of Indian capital. What was Indian banking was pushed to the wings as banks controlled by Europeans began to dominate. If you look at the depositions by Indian traders before the Central Banking Inquiry Committee in 1929, they very often complained of discriminatory treatment by the Imperial Bank and also by the exchange banks. They had to pay larger amount of fees. A certain value of the total value of the merchandise had to be deposited in the bank in order to obtain credit. So credit for many of these Indian businessmen was not so easily available from these exchange banks dominated by the Europeans. The small number of Indian banks that had begun to grow from the turn of the century under the impact of the Swadeshi, many of these banks actually failed to survive. Ultimately, during 1930s, in an altered political situation, Indian banking also began to flourish, but that's another story. The point that we were actually trying to emphasize at this last stage of the discussion on this transition from traditional banking practices to a modern banking structure is that what you saw as traditional banking did not entirely disappear. They survived. They survived in the bazaar. They funded small-scale business, small-scale industry. The credit operations in which they were involved, actually funded commercial agriculture. So the indigenous financial network, these bankers or financiers or the shroffs did not simply go away. This is a point which needs to be stressed, because in many instances these people continue to act as a kind of a conduit between banking finance, which might have been by then controlled by the foreigners, but you have this interior agricultural market or the agricultural field where the credit flowing through them actually reached the farmers.